Hey, what's going on, guys? I'm Dr. Boyce Watkins, and I wanted to, I just got to California. I'm doing a half marathon on Sunday. It's a long run, and it's like you never finish running, but it's half of a full marathon, but I'm looking forward to it. So wish me luck. But anyway, I wanted to share something that I was reading today. I was on the airplane. I was reading The Economist, and one of the things that they brought up, they were talking about companies that are called unicorns. Unicorns are these small tech startups in Silicon Valley that are worth over $1 billion. Now, there are a lot more unicorns now than there used to be because there's so much venture capital money being thrown at these new companies. And I'm going to tell you, I think Silicon Valley's kind of doing it all wrong. Honestly, I think that it's getting to the point where it's become sort of this out of control fad where they just think it's easy to make money. And what is effectively happening is they're taking a business model with a lot of the unicorns that I just don't agree with. And basically what it is they are throwing money at these companies so they can engage in massive amounts of customer acquisition. They call it Blitzscaling. Blitzscaling is where you just scale the hell out of the company and you say, look, we're just going to acquire 100 million customers, and then we'll figure out later on how we're going to make our money. Well, as a result, what's been happening is these companies are losing billions and billions of dollars. Uber and I think Uber was one of them that they talked about, and there were a couple others, WeWork and a few others that are scaling really fast, but they're just not making any money. And so here's the thing, your stock price, the value of your stock price pretty much comes down to the present value of your future cash flows. And so when you give a valuation on the market of a company that doesn't have a profit, you have to speculate on what the growth rate is going to be, what the margins are going to be, when they're going to become profitable, things like that. And basically, here's the point that I want to. This point stuck out to me, and I'm going to do a deeper analysis on it when I get a chance. I'm traveling so much right now that it's hard for me to sit down. But basically, the amount of growth these companies would have to sustain in order to justify their current market valuation is, I think, 49% per year for a decade or something like that. And then their margins would have to grow astronomically large as well. And basically what that's saying in so many words is that a lot of these companies are overvalued. Their stock market price is not what it should be. So what you can expect is that if there's a major market correction, meaning if the market suddenly gets hit hard, or we have a downturn, or there's a bubble that bursts, the tech stocks, these unicorn stocks, are going to get body slammed. And so how am I going to respond to that? Does that mean I own none of these companies? No, not really, because to some extent, unfortunately, it becomes the last man loses kind of effect, a little bit like a Ponzi scheme, in the sense that the bubble can still expand. You can still buy and sell later on for a higher price. But I definitely know that diversification into tried and true blue chip companies that have real value with real assets that make sense, that are not in this unicorn category, can be beneficial to your portfolio. So I'm not telling you how to do things. I'm just letting you know what my analysis led me to believe. And after reading this article and kind of going through it and thinking through things that I'd already read before, I realized that most of these big tech companies are the result of economic fads. They're very trendy. It's very trendy for these companies, for these venture capitalists to just toss, billions and billions of dollars at these companies, and they're just not a good deal in my opinion. So because there's no way these companies, I think that the growth rates that they need to have in order for them to become profitable have to match the growth rates of companies like Amazon and Google. And to expect all these companies to become similar to Amazon and Google is kind of crazy. So just be careful when you're dealing with the tech companies and the IPOs and the unicorns. And you'll also notice that there is kind of a deflated enthusiasm with these new IPOs. It's not what it used to be in, say, 2016, 2015. These companies are launching and they're not, doubling in price and things like that. They're actually dipping in price. And so a lot of these tech IPOs are not good investments from the jump. So that's it. That's all I wanted to share with you guys. Make sure you hit the thumbs up button. Make sure you hit the subscribe button and everything else. And subscribe at theblackfinancialchannel.com. That's theblackfinancialchannel.com if you haven't subscribed. And last but not least, go to blackfinancial blackfinancialintelligence.com. That's blackfinancialintelligence.com. We have books, flashcards, all kinds of things that can help you beef up your financial literacy. So take care, guys. I'll see you soon. Bye-bye.